Welcome back to the Titans Up Today podcast. My name is Jacob Vandersteen, the founder and chief executive officer of the Manuka Network, and I have this amazing individual here, Elijah Levine. He is the co-founder, CEO of Black Mountain Investment Group, and also the GP of the Jupiter Fund. Elijah, welcome.
Thanks so much for having me, Jacob. It's a pleasure.
And happy to see you as well. So what we're going to be discussing and talking about today, it's fresh on everyone's mind, is really the capital markets, how money is being influenced by the times today, by the previous economic history over the last 10, 15 years and even beyond, and how that's influencing everyday entrepreneurs, investors, founders who are in this market. So Elijah has firsthand experience, not only from building, launching tech products and tech companies, but investing in them and working with founders on a regular basis. What are you seeing today that is different from maybe where it was 3 to 5 years ago?
Great place to start off there. I think even in the last 3 to 6 months, and especially in the last 12 months, we've seen a massive shift in all capital markets. Some places that you're seeing it take a little bit longer to trickle down. However, obviously the stock market, the crypto markets, and the early stage VC market have seen massive shifts over these last few months in terms of the liquidity available, the willingness for investors to pour money into early stage projects without meaningful points of reference for growth and success in the past. And so you're really seeing a lot of the more early stage markets, as well as a highly liquid market such as equities, be very affected by the increased interest rates. And I think as those rates stay high, we're going to continue seeing these effects ripple across the entire ecosystem, including to less liquid assets such as real estate. You're starting to see that with increased foreclosures across the country, as well as increased debt, not only consumer debt, but real estate debt that is coming due kind of in the next 1 to 3 years. I believe it's over 2.5 trillion just in that time. And this is less so on the residential level, but more so on the commercial level in offices, retail, hospitality. And they're going to be forced to refinance in a rate environment that really hasn't been seen for the last several decades. And obviously, we've seen those early stage effects in the liquid markets, and what's going to happen to the less liquid markets is going to be perhaps even more catastrophic. That being said, you're already seeing the government step in and reverse on a lot of its recent momentum towards quantitative tightening, with $300 billion going to various banks to bail them out and make sure that depositors are able to get their money out. It seems like a Band-Aid on a bullet wound in terms of how bad this issue is, and how it's likely contaminating almost every bank out there, except really the big four. These regional banks are getting hit especially hard, and that's likely only going to continue. This is the product of several things. The first is not marking to market all your assets in a quick and transparent way. And that's something we actually talked about in our latest article, where we use a concept in blockchain called proof of solvency. And we're basically saying that not only is this very applicable to blockchain and the world of crypto, but it's also extremely applicable to the traditional financial systems, especially banks, especially at this moment.
So where are you seeing, and maybe that was part of it, the fast moving water? Where's the money going more smoothly? Because I'm always of the belief that money, aside from, let's say, quantitative easing or quantitative tightening, isn't necessarily created or destroyed. It just is going to another place. The money is being invested into a different asset or moved around. So where are you seeing that fast moving water?
Totally. I think you're seeing a lot of intelligent companies double down on doing things themselves. For example, JP Morgan, Citibank, and more are building their own in-house blockchains. I think you're seeing a shift from early stage investments in companies that might have been building a disruptive technology, for example, tokenizing bonds. And the lending market is one of the biggest in all financial markets. Similarly to real estate, equities, and traditional monetary flows, it's very outdated space. And so there is room for disruption. And I think where you're seeing the capital flow right now is from more early stage disruptive startups that were tackling these problems into or retained by these large institutions that are working to solve the same problems and already have all of the network, the expertise, and the talent to actually make those systems work and implement the technology in a way that is going to be applicable, trusted, and operational.
Very interesting. And how does that influence then the innovation ecosystem, let's say for entrepreneurs who are starting companies?
Definitely makes it a lot harder. And I think that's why you're seeing just less deal flow. The amount of companies being formed right now as compared to 1 year ago, 2 years ago, especially, is just much lower. You're seeing people do down rounds, folks that came to us seeking a $20 million valuation 18 months ago, and we told them that was a little too hot, are now coming and saying that they're seeking a $5 million valuation. Those are companies that have seen meaningful growth in revenue and profit, and really just a wake-up call. And so, while I will say that, yes, the money is more so being relocated than anything, there is still asset value destruction happening. And that is largely a product of the higher rate environment. Real estate is a good way to think about this, but the public markets, or it's apparent in the public markets as well, where a lot of valuations are predicated on multiples. And in real estate, the multiple is called a cap rate. It's basically an inverse multiple. So the lower the cap rate, the higher the multiple, and therefore the higher the value. The average SaaS multiple during COVID might have been 30 to 50 times in some cases on revenue. And now you're seeing those multiples down in the single digit, maybe low double digit range. And so I think that's definitely just part of a healthy cycle, something that happens when rates rise. Similarly, cap rates rise. And so the valuation on real estate and all these public companies are just going down. And I think there is a little bit of wealth destruction in this case. And that comes from a government and frankly, like a world of businesses that have been terrified of high inflation and assets losing their value, not only in the dollar sense, but in terms of their relative value compared to other things. And so I think this is just a response in terms of wanting to keep valuations all proportionate relative to each other, and something that's very healthy and important, yet still is causing pretty dramatic effects throughout all of the capital market ecosystem.
So let's talk more about the real estate market, as you mentioned, and the way that the increase in rates is influencing behavior all across industries, especially if you look at SB losses on mortgage. That was part of that, what ultimately occurred. So I'm going to enlighten more of the audience of how those changes affect banks and other players in the market.
Sure. Yeah. Really good question. And this is something that I've been speaking with some of the most important people in real estate about over the last few months, people that manage 50 billion, $100 billion funds and organizations. I went to Singapore for the Wharton Forum recently, spoke with some incredible people there, spoke with some folks from other large asset managers, both in the early stage world and in the real estate world. And what's happening is pretty unbelievable. To put it in very simple terms, as rates rise, opportunities need to get more competitive. That's because you have an institution that's arguably one of the most trusted in the entire world. We'll see if that lasts. The United States government is one of the most trusted in the world. When they raise rates from, say, 0 to 2%, where it's been over the last several decades, people have gotten accustomed to, all these people that work in the business world have gotten accustomed to. And now basically a risk-free rate is becoming 7, even 9% in some cases, which generations before us knew as their norm, but the last couple of decades have never even experienced. So what that means for an asset class like real estate that traditionally has lower returns anyway, is that investors are not as willing to take on risk, the risk of a new development project or even a value add project, and even core projects really that are producing like 5 to 7 to 9% returns. That seems too risky because now you're being forced to compare that to a frame of reference that is the United States government versus a DeFi yield project that was giving like 14, 15%. And so basically risk is being repriced across all of capital markets, meaning that investors are being forced to think more critically about where they're putting their money and what risk should be relative to all the other opportunities in the market.
Let's expand on those risks. If you're ever going to go raise capital, there's a framework that investor has. You hear it's a thesis, but it also goes much deeper than that. So let's talk some more about those risks. And then also we'll talk after that just about on what I experience with a lot of the deals that I'm working on now is even debt lenders are more aggressive actually to get more debt out. And so we can touch on that as well.
Absolutely. Yeah. And that's totally another effect. And one thing I wanted to quickly touch on as well in terms of why this is really dangerous is that when rates are rising, like you're saying, people that have lent that money are also becoming more cognizant of the fact that they might never get that money back. Therefore, banks are not as flexible to extend lease terms or forgive interest right now, which they might have done in the past. And especially in terms of regional banks that are failing to meet their obligations to their depositors, you are going to see a halt, if not a significant slowdown in lending, which means that people like your neighborhood carpenter are not going to be able to get loans to keep running their business, or your neighborhood farmer isn't going to be able to rent his tractor, and your local construction project is not going to get approved because the economics will never work with how high the construction rate loan is. And so what you're going to see is a massive slowdown on the regional level in terms of small projects, which leaves a massive void that needs to be filled, and that eventually will be filled, hopefully, if state and local governments are able to work with the federal government in order to actually direct this funding in a positive way. Because what's happening right now and what's happened historically is a lot of consolidation in times like these when there's distress. And this kind of goes to what you're saying about debt collections, is that if you can't collect the debt, oftentimes there's covenants that you can take over the asset. And that's a big reason why a lot of debt funds have been successful, but also why they get such bad reputations. And so what's happened in basically every historic recession is a significant amount of consolidation. And that's exactly what's happening now. And that in the form of billions in new deposits to JP Morgan every day of the last few weeks because of the distress from First Republic and SVB, et cetera. And you're going to start seeing a lot more of that, where the rich get richer and the poor get poorer. And that's going to be in terms of the banking sector, but also in terms of local development, from a real estate perspective, from the tech startups perspective. It's really going to be felt throughout the entire economy at all different levels. And I think we're in the early stages, perhaps maybe the eye of the storm, or just approaching the eye, but it's definitely really just a factor of how long rates stay high because of these compound effects that they have throughout quite literally the whole economy.
So if you put yourself in the shoes, or even the past conversations that you had with those people who are running $50 billion firms, let's say you, Elijah, you have this 50 billion to allocate in the best way you best see fit during these times. If you're thinking across the market, the globe, where would you be putting that money? How would you be seeking to maximize safety, priority, and then returns?
Sure. So it comes down to two things. And one that you asked me to expand on is risk. And I think that's the first consideration. And then the second is what structures and entities you have in place to deploy capital out of. And both those things go hand in hand. And those are really the two biggest decisions or factors in your decision for placing capital, because most capital allocators take their money from investors. And the larger the investor, typically the more rigid requirements in terms of how they can deploy that money. For example, big real estate funds that have $100 million commitments typically have a lot more structured rules and regulations of LP rights. LPs are limited partners or the investors, as well as discretionary ways that they're able to spend that money. Is it discretionary at all, or is it completely rigid and needs to follow a set of predetermined rules that you worked with the LPs to establish? And for smaller funds, especially like us, it's a lot more discretionary. We basically have the option to put the money broadly wherever we want. We try to keep it along the lines of our thesis and emerging technology and places where industries that have had outdated technology, and there's room to improve that technology, improve those processes. But that being said, I think that when investors are repricing risk like they are right now, something like a bond is arguably one of the safest places to put money. That resets all those prices like I was talking about. If bonds were at 2%, real estate, which is the next less risky, especially if you're comparing this to early stage VC, private equity, and even public equities, in obviously depends on the sector, but in the tech space, for example, real estate's arguably one of the safest asset classes. And 2 years ago, a 7% return in a real estate vehicle might have seemed attractive because of how low the treasury rate was. However, now that the treasury rate's been pushed up 5%, real estate returns need to bump up 5% also in order to remain attractive to investors. The problem with real estate, however, is that largely in commercial real estate, especially, the industry is filled with floating rate loans. Real estate's one of the most levered asset classes out there, and its leverage is especially risky because it's floating like that. And so rather than that 7% returning asset moving up to 12% to remain attractive, it actually goes down to 2% because its debt rose 5%. And now instead of that 7% being their profit, now all of a sudden their debt expense is 5% higher, meaning that they're only clearing at 2%, which doesn't leave a lot of room if rates continue increasing. And That's why I think we're going to see, and already are starting to see, a huge amount of distress in these markets, especially as loan maturities come due, because they're getting hit with a double whammy in terms of not only having enough cash flow to cover their liabilities, but also having less of a value on their asset that they're able to use as a benchmark to extract more money in the form of a loan. And yeah, I definitely think it's the early stages of what's going to happen with that, and that commercial real estate, highly levered businesses, especially on floating rate schedules, are going to be especially vulnerable.
And so would you say that to bring it all together across asset classes, if you were to answer a little further about how you would start to allocate some of that 50 potential billion, because you yourself have a lot of experience with the leading technologies, and though the innovation ecosystem is changing a lot and we are seeing these factors at play, where would you allocate that money given, even if it was just general percentages about where you're seeing things moving and how the value could be created?
Yeah, totally. And so I think that goes to the second point, which is what vehicles you have to invest out of. But like I said, our vehicle, we've tried to purposely make it as discretionary as possible, where we can allocate into early stage, late stage equities, whereas like a lot of people don't have that, and they have very rigid protocols that they need to follow in terms of where they invest. And so if you could wave a magic wand and have all sorts of equity vehicles, debt vehicles, I think a mix of those would be awesome. Especially distress lending, I think, is really a place where all of the opportunities are going to be over the next couple years, and also distressed equity. And that's what we've been angling for with our fund, is picking up these deals that might take $25,000 to build plus 6 to 9 months of development work, but are available on the market right now for $5,000. And it's just a deal because people are in need of liquidity. And in those kind of more liquid, smaller markets, you're seeing early signs of that. And I think you're going to start to see that on larger scale in terms of more traditional financial assets. And therefore, if you have an opportunistic fund that is investing in companies or real estate, you're going to be in really good shape. And if you have a lending business, that's going to be even better, because not only can you have the quote unquote safest returns in the capital stack, but you also have claim over any of the assets that go bankrupt.
Wow.
Yeah, so that's why debt funds are largely called predatory, and some have steered away from collateralizing the assets that they're lending on. But that being said, you can't really lend on somebody, especially if they don't have good credit, without them collateralizing something. And usually the easiest thing is the asset. It gets worse when lenders are like, okay, now cross collateralize 5 of your assets, or your personal liabilities, or your house, or different things like that, which is totally normal and regular practice, but it can be seen as predatory. And so I think that's where opportunities are for sure. But in general, we've been saying this for over a year and a half. I think cash is king, and resources in general are king. Assets of all types that are used to transact different things are where the value is going to be, because everyone's chasing Bitcoin when it's at 50 grand. Everyone's talking about it. And people now, even though it's up a lot, I think it's up like 35, 40, maybe even 50% in the last few months. And people are still buying it, but it's just funny when it's down at 20 grand and you're talking about it, it seems so risky and scary. And so I think it's really important to not follow crowds and to try and understand not only the fundamental landscape of asset valuations, but also the psychological landscape of the world. And the investors in different assets really give you a better gauge for where things are pricing and where they should be pricing.
The inverse approach.
Yeah.
No, excellent stuff. So let's start to talk about some of those waves, though, of innovation that are flowing up across AI, ESG, all these other technologies that are really, in my mind, we have that innovation curve and how GDP is influenced by innovation. I think we're just on this massive inflection point that is overcrowded by everything that's happening economically, but ultimately it's going up and to the right. So tell us more just about some of those technologies and how you're excited about that and some of the waves that are happening there.
100%. This is probably what I'm most excited about, and have been the most excited about for my whole life, is how tech is changing the world in ever more rapid ways. Growing up, just transitioning from like a flip phone to an iPhone felt like entering a sci-fi movie. And the same thing has happened recently with AI being completely democratized in a way that is flipping so many industries completely upside down. And not necessarily in a bad way. I think that this is an inflection point where the new generation of companies that are moving into the ecosystem actually care about the users. They're not price gouging. they're not taking advantage, they're listening, and they are not being deceptive, which is completely different than all of the companies that have been popularized since early 20 Instagram, Facebook, you name it. Companies have been unbelievably predatory in terms of gouging data, doing psychological ops against you in terms of what advertisements you're being fed and the products that are being served up to you with these targeted ads. It's not that it's a problem to advertise. It is, in my opinion, though, a problem to treat users like they are the product without telling them they're the product, because you are giving your information to these companies for free in exchange for being able to use their product, which is totally fine. It's reasonable, but it makes sense to at least tell them about that and tell them how it's either being used for your benefit or your detriment. And I think that's only been done through Netflix shows like The Social Network, and now, ironically enough, is being brought to light on these social media platforms where a lot of people are watching videos or hearing news about how they're being flipped on their backs in terms of like the expectations, and if consumers actually like that or if they want to move something that's more transparent. Another area that I see AI really changing things, AI in particular, because the fact that OpenAI released arguably one of the most powerful software tools for free, and then an upgraded version for $20 a month. Right now, you see enterprise SaaS companies charging thousands, if not tens of $1,000s a month for products that were much simpler and cheaper to develop and that have far less application. And so I think that's what's going to really change in just all of those two things together. Social media mixed with the value per price of products that are now available on the market is tipping like enterprise SaaS and retail kind of B2C tech upside down in a lot of ways, because the new era of companies are starting to treat consumers with a lot more transparency, which I think that they want and that they're going to continue to demand, especially as they've gotten a bigger and bigger taste of over the last few years.
Yeah, so it's like the Web3, blockchain, AI, and all these ESG, those large, fast-moving trends all have a similar tone, feel, and theme about bringing it back to what really matters, the people, the experience, and real value. One thing I'd like your feedback on or thoughts about is I have a really great friend. His name is AJ Malik, has over 90 plus patents across networking and AI and all these other things. So I see him as the Thomas Edison in essence, still on his way there. And he mentioned how with AI, what he sees is there's going to be a massive transition into these hardware companies becoming more valuable and better investments than software, which is what, as you mentioned, you and I, for so long, it's been everything is software. But he thinks that because of AI, the value out of software will be, and people in software will be integration, whereas AI will drive a lot of the details, and you're going to need better hardware to process all these outcomes and create different experiences. So what are your thoughts on that? And so I haven't heard that from anywhere else, so I thought that was very unique.
Yeah, I think that's spot on. And that's something that I've been talking about and writing about for a while. Great article I read, and I can find a place to link it in the show notes. But it basically talked about how all these studies, even coming out of my school, University of Pennsylvania, as well as like from Goldman Sachs, these studies are coming out saying how AI is going to replace all these jobs. And this article that I read actually argues that these conclusive studies are using the wrong measuring tools when making these very abrupt statements. And if you look at even just the rise of the internet, everyone thought that was going to take people's jobs away. People thought that Google was going to replace all analytical roles. And what did it do? It actually enabled those analytical workers to be more efficient, get more done, and open up more opportunities for roles that no one even imagined. And I think that same thing is going to happen with AI, and that it will make people's jobs more efficient, especially in the software space, like we're seeing, especially in the content space, things like customer service, legal work, accounting work. Oh my gosh, it's unbelievable. And even in the medical space, there's been some incredible stories about people uploading blood work to ChatGPT and it having more accurate predictions than veterinarians or doctors, and same thing with coding. So it's really remarkable. I think more than anything, AI is going to help us. And I think that if we look at it like a tool that's going to help us, it's going to. But if we look at it like something to be scared of and that's going to replace us, you're probably going to get replaced. But that's just like you making excuses rather than trying to understand something new and exciting. That being said, especially as hardware is an interesting one. My take on that is that manufacturing is going to be a lot bigger. Jobs that require manual labor as well as soft skills are going to become ever more important. Things like therapists, plumbers, electricians, stuff like that, going to probably become a lot more valuable in the eyes of society with the rise of tools that can do everyone's job for them at a much cheaper cost. That being said, I think we won't really see a decrease in either robotics and AI are working more in tandem. And that kind of goes to the hardware aspect. I think that obviously chips have gotten smaller and smaller, more efficient, but that doesn't mean that hardware is just going to stop and become irrelevant. It means that more intelligent hardware, just like more intelligent software, is going to rise up and now replace restaurant workers and eventually maybe those plumbers and electricians. But you're already seeing really fascinating applications. Microsoft HoloLens is one of my favorite. Robotics, metaverse glasses, AR, VR, and AI working in tandem for, say, an elevator electrician to go and see a control box through glasses and diagnose the problem seamlessly in a matter of minutes versus digging through the control box, trying to figure out what went wrong. This has really only been made available by sensors, Internet of Things devices, as well as the ability to have all those data points tracked, analyzed, and visualized all in one place, which really doesn't seem too complicated, but it is really new. And I think as more systems are centralized and more technologies are brought together, we're going to see even more disruption at even more levels to the economy. But that hopefully in the end, it's all going to be very accretive to us as a society.
Absolutely. A lot of amazing and exciting things being driven by these waves, and even the headwinds can start to allow these things to pick up steam. So thoughts here, what is one mantra you would leave for everybody that would just help them get the most out of the next few years, just based off of your day-to-day experiences?
One thing that I'm always talking with our guys about and that you hear about in some of the best institutions in the world is just to never stop learning, never stop improving, and to never stop being scared of change. If you have an outlook like a new technology is going to ruin your career and your path in life, it probably will. Whereas if you look at it like an opportunity to do your job better and to carry you into the next stage of your career, which is going to be even better than the last stage, then that's probably how the outcome will be.
Excellent. Thank you, Elijah, for being on the show. Any place that we can find you specifically or get in contact with you?
Yeah, definitely. DMs are open on LinkedIn, Twitter, Instagram. Elijah Levine on LinkedIn, Levine EL42 on Twitter, and Elijah_Levine on Instagram. And our website is blackmountainig.com. Happy to talk more on any of those mediums. And thank you so much again for having me, Jacob. I really appreciate you letting me on and taking the time to ask some incredible questions.
You're welcome. Everybody, there you have it. That's Elijah Levine. Go ahead and check him out. Thanks for tuning in to the Titans Up Today podcast. Go back, rewatch this one. There was a lot of amazing insights from Elijah. Have a phenomenal rest of your day. We'll see you in the next podcast.
Hey everyone, thank you for watching this episode of Titans Up Today. What did you learn from it? Make sure to drop a comment below with your most valuable insight so that other people can engage in the conversation around what this speaker brought to the table. And then on another front, make sure to subscribe so that every time we drop a new episode, you will be notified. And that way you can keep fueling your dreams and your brain with fresh insights which can help you along your journey and along your path to your goals. So thank you so much again, and I look forward to seeing you in the next interview.